immediate reaction to a fairly ominous call, to say the least, from Scott Minerd just now.
That's exactly why the market has been rallying the last couple of days, because there is this overwhelming pessimism that has been rebuilt into the market again in reaction to Chairman Powell's Jackson Hole speech and the price action in the month of August. Statistically, everything that Scott cited is accurate, it is on point, and it is indicative of an earnings outlook that should see earnings contract and see a lower valuation, in particular for hyper-growth type of equities. But collectively, with all that being said, okay, if I'm thinking that a very strong period is coming between November and March, and I ultimately have to incur 20% down in the market ahead of that, okay, individual equity holdings, I'm not so sure I'm going to be selling them here. I'm going to go to the derivative market, and it sounds to me like that's what Scott was doing. I think he said he's got some S&P puts. I'm going to go to the derivative.
He said sizable.
Okay. I'm going to go to the S&P derivative market. I'm going to go to the derivative market overall, and I'm going to formulate a position to take advantage of a near-term outlook that I have, believing that prices can fall precipitously. But for my core portfolio equity holdings, I'm not going to move on those. I'm not going to sell those. I'm going to maintain my long exposure.
So, Steph, Joe brings up a good point that I feel like our viewers are going to be thinking about as they just listened to the conversation with Minerd and wondering what they're supposed to do. Conventional wisdom would say you're not supposed to sit here and call your broker and say, sell everything, because when are you going to know when to get back in? That's conventional wisdom. And I think most of our guests on this network, whatever program they're coming on, would suggest that. However, if you do think that we're going down 20% or so in the next 4 to 5 weeks, what would you advise people to do?
Well, I think it's really hard, Scott, to time it. And I think Scott was saying it's going to be a great time to trade stocks if you're a trader. But if you are a long-term investor, you do want to have a diversified portfolio. You want to upgrade your portfolio in terms of quality names, free cash flow companies. We've been talking about it all year long. I've been doing it all year long. And so I think you stay the course and you stay patient. You keep your head down and just try to focus on the fundamentals. We've talked about this year being a very choppy market, a trading range market. We're up 9.3% from the June lows, and nothing really has changed from the June lows. And today, the Fed just reiterated what they've been saying. All of the governors and Powell himself have been saying that they have to be more hawkish because inflation is still very persistent, and as a result, they're going to slow down the economy. And so none of that was a surprise today. I don't know why we rallied today. Maybe we got oversold. But I think in these kinds of environments, you have to just stay the course, be committed. Equities are a good long-term investment, especially if you have companies that are growing their dividends. That's why I mentioned free cash flow. So I can't day trade and I can't time the market. All I can say is I'm looking at my companies where at least I have some confidence in earnings. Maybe they're going to come down a little bit. They probably will. But I still like the long-term themes at companies, long-term market share positioning, and good company management teams.